This is Trepp Wire Week in Review for week ending January 29th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, earnings season kicked into high gear, and a roundup of economic data was mixed. Fourth quarter GDP in the U.S. grew at 4%. Initial jobless claims dropped slightly. Sales of new homes increased in December, and consumer confidence rose in January after 2 months of declines. And Wednesday, Fed Chair Powell said the most important economic growth policy is getting people vaccinated. But most of the talk this week has been about the short squeeze frenzy. Manus, everyone is talking about the market volatility that is centered around stark moves of a handful of stocks. Is there something else going on there?
Well, the one thing I would say about this is that for those new to the CRE markets, this might be something that you think you can sleep on, but this is not something you could sleep on. And I'll get into why that is. I won't go through all the reasons why GameStop and AMC and Nokia and others are surging. All you have to know is their stock prices are up hundreds of percents over the last couple days. They've been going up 100%, 200%, down 50%, up another 100%. What is happening is retail investors are driving the stock price up, and these stocks are heavily shorted, and hedge funds are taking enormous losses right now, paper losses, and in some cases triggering margin calls. Those margin calls have been triggering bailouts in some cases. So that's the big picture story right now. Zero Hedge has been covering this very well, the Wall Street Journal as well. Zero Hedge said as of Thursday night that they think paper losses, I believe, are $70 billion for the hedge funds at this point. So that's the overarching theme. Now, why does this matter to the CRE markets? And you have to look back to your history of this space. And this may take me 3 or 4 minutes to go through, and hopefully I don't lose the audience in that
Is it because GameStop can now open like 7,000 new stores?
Or they could issue stock, right? If they could figure out a way.
They're going to issue stock.
To issue stock in the 15 minutes that they're up 600%. So let me take you back to 1998. 1998, shortly before the dot-com bubble, we had a real crisis in confidence in the US. We had a hedge fund called Long-Term Capital. They were run by John Merriweather. He was a fixed income guy from Solomon. He had put together really an all-star team of people from Solomon. They had been really the most successful fixed income and MBS traders early on in the securitization world. He put together this hedge fund. He added some board members like Myron Scholes and Robert Merton, who had won the 1997 Nobel Prize in economics for the Black-Scholes model that they built, which is a way of valuing fixed income. The long and the short of it is Long-Term Capital was a hedge fund. They probably had about $5 billion of their own money, but they were levered up 25 to 1. So they had bets on the table of about $125 billion at the time. In August of 1998, the Russian government unexpectedly devalued their currency, leading to a Russian debt default. This had an enormous impact on Long-Term Capital and made them insolvent. Their funding came from many large US banks, really the top 15, who at the end of the day resulted in a bailout. These 15 banks bailed out Long-Term Capital to keep this from becoming a contagion. And at the time, BlackRock had a very big financial position in Trepp. They were an equity investor, and we would meet with them regularly, and they talked about there being blood in the water. And you could see it because this volatility, even though it was limited at first to the Russian debt crisis, spilled over into all other fixed income. And fixed income spreads started to blow out by first dozens and then hundreds of basis points, leading to huge paper losses for hedge funds and money managers. One of the people that suffered a huge paper loss was Nomura. They had been sitting on, if I remember correctly, and I'm doing this all from memory, $20 billion worth of CRE warehouse debt waiting to be securitized. Overnight, there was a $2 billion write down of that value, which they had to recognize in their quarterly earnings, and almost led to a liquidity crisis for Nomura itself. So there was a huge contagion if these 15 banks hadn't gotten together and agreed to recapitalize long-term capital, the hedge fund. We could have seen kind of a 1998 Lehman Brothers type reaction. So at that point in time, anybody who had warehouse debt in commercial real estate got buried, right? They were selling their loans at huge losses. And at the time, nobody saw this coming. People were making bigger and bigger and bigger warehouse lines, hoping to have $2 and $3 and $4 billion deals to drive down their fixed costs. And what happened is, for those that had big warehouse positions, there were huge losses. And in Nomura's case, they shut down the entire operation that had been so successful from 93 to 98. Fast forward to 2015, similar type of thing. Oil prices dropped from $100 a barrel to 40. Hedge funds get in trouble because they were big buyers of leveraged loans that were made to energy firms. These firms start going bankrupt, spreads start blowing out, fixed income spreads across the entire spectrum start to rise. And all of a sudden, warehouse operators again are faced with big paper losses. They can't get the loans off their books at profits. In that particular case, we saw a 3 or 4 month shutdown of lending in the CRE markets, for which there was no lending, no issuing, no originating, no nothing for about 3 months until spread volatility settled down. So if you're an originator, a warehouse operator, an investor, you want to keep a close eye on who is being impacted on the hedge fund side, because this is the kind of thing that, even though it seems like retail stocks right now, you never know where it goes from here.
So Manus, the question for me anyway, and here's my counterpoint to your argument, is that LTCM was huge in the fixed income market, right? So whether, I don't know all the bells and whistles and the hooks then, I think I was in 8th grade at the time, but I could see the direct correlation between them, their warehouse providers, and the fixed income market. Same thing on the oil side, right? It was high yield bonds. Their spreads blew out, which kind of just pulled all fixed income spreads wider. If it's GameStop and I can see AMC maybe, right? They have some leverage loans out there, and it's a couple of hedge funds who are in the equity space, and with all of the liquidity in the market and the Fed already standing by bailing everybody out left and right anyway, is it as much of a concern now?
Maybe yes, maybe no, right? On the Fed side, back in 1998, the Fed was not willing to get involved. This was a Wall Street problem that Wall Street had to solve, and Wall Street did solve, right? By infusing capital into long-term capital, settling down the markets, and letting them dissolve in what was called an orderly fashion. We are going to give you enough money so that there are no margin calls on you today, and you could sell these assets that you have not at bargain prices. The Fed may, just jump in right away. And Biden's spokesperson yesterday said the Fed was watching this very closely, which means that they probably would jump in. The counter argument to the unknown is you just don't know. It's a little bit like whack-a-mole, right? We saw that Point72, which is Steve Cohen's hedge fund, was one of those bailing out a firm that had been heavily hit by the short squeeze of GameStop. There were a couple of other hedge funds that pledged, I think, between $2 and $3 billion thus far. And there's a lot of interconnectivity between these hedge funds, right? Hedge funds invest in other hedge funds, right? And when somebody starts getting margin calls, what they're forced to liquidate is often their most liquid things, whatever that is, whether that's treasuries, AAA, right, CMBS, and whatever they have. And it doesn't really matter what happens in terms of what's being sold. If what's being sold starts to see this downward spiral where things start to trade at 10-point discounts, 20-point discounts, that will attract capital from other areas. And that attraction of capital from other areas will send spreads up in assets that are otherwise unimpacted, right? That's what happened in 2016 with high yield.
Yeah.
Once those spreads exploded because energy defaults were ticking up, there was a gravitational pull towards them as their risk return became more attractive.
I remember when Sheets was banging the drum on that early that year.
I am so glad you reminded me of that because it was in my notes and I couldn't find it. I'm glad you did that. Don Sheets opened our eyes to that problem, and he's been a guest on our podcast, and he's a great speaker. He's a professor at Columbia and NYU.
Yes.
He also is a distressed asset investor. He was very forward looking on this and called it about 2 months before it really became a peak problem.
So we don't want to spend too much time on this. I mean, this is better served in Reddit threads, but the crazy thing about this is they could do this on any stock that has heavy short interest. Like, they might shut down trading in GameStop and AMC, but like there's probably 30 other stocks that have greater than 50% short interest that at any time, 1 million people on Reddit can just say, hey, go buy that and cause a short squeeze and make a bunch of money.
Right. They're plentiful. They run the gamut of big names to small names. Sometimes there's penny stocks. I do get very alarmed because I hear of people texting me, family members, asking, should they set up a Robinhood account? They hear people making 10 times their money. That's a little frightening. But to go back to the hedge fund issue and long-term capital, I am a bit of a tourist in the hedge fund space. So I'm taking some of this from memory.
So yeah, enough on this, but I will say that I got text messages from people I haven't heard from in years who reach out to me because they think I know something about investing or something. And they were saying, hey, am I crazy or should I be buying AMC tomorrow? So
Wow.
I basically said, if you want to like totally gamble and have fun and like have a very high potential of losing all your money, go for it. But otherwise, I'm sticking with my plain vanilla boring stuff.
Yeah, people ask me the same thing. I told them I'm sitting this one out largely because I do think that if you're going to do something like this, you need to be at your computer all day long.
Right.
And because, these waves come so quickly that you got to be in and out. And I don't want to be somebody who can't walk away from my computer and, put on that Bob Ross paint show for a little bit and kind of clear my mind.
Clancy Day Trader Global.
That's not happening.
So let's turn to retail news. We saw a number of store closures announced this week.
Yeah, we predicted this in December, and it wasn't really a terribly insightful prediction. Every January, we see another wave of store closings. People get through the holidays, and then they say, well, it's going to be 12 months before we get to the holiday season again. We don't want to carry this. Let's shut it down. What we saw this week, Godiva Chocolates, 128 stores, which I was shocked that they had that many operations. They're going to close all 128 stores. A lot of mall locations. American Eagle, 200 to 250 stores they announced would be closing. Best Buy, we saw some drips and drabs from them of shutterings that would be forthcoming. And the one that we're really keeping an eye on right now is Belk. Belk is private equity owned. They have substantial debt in the leveraged loan market, which has made itself into the CLO space. We've written about that before. Jody on our research team has done a lot of research over the last several months about this particular topic. But anytime you see a big retailer go into bankruptcy, the next question is, which stores are they going to reject the leases on? We're waiting for that to come out. We think that there will be some of that. And in Belk's case, they do have a large North Carolina office that backs a big CMBS loan, which theoretically, if they were to liquidate, or if they decided that they wanted to have a much smaller presence, they could reject that lease, and that big, I think it's a $45 or $55 million CMBS loan, would immediately become a loan of concern. So a lot to keep your eyes on there.
And we had a couple of trading alerts that are going to take us down a couple paths. The first was the Catalina Small.
Oh boy, we have some complex stuff today. The Las Catalinas Mall is in Caguas, I hope I'm pronouncing that correctly, Puerto Rico. It's about $125 million mall. Like so many malls, it was hit hard by COVID, some shutdowns, lack of foot traffic. It went delinquent in May. Ironhound got involved. Ironhound is somebody that works on loan modifications, workouts. They worked out a modification on behalf of the borrower that increased the maturity period by a year and a half. So pushes the maturity date out to 2026, makes the loan interest only, so no more amortization. And then lastly, I believe there was some rate relief. So at the moment, there's still $125 million of loan outstanding. In one case, it makes up 7% of a JPM 2014 deal. The interesting thing is this modification allows the borrower to pay off this loan with only a payment of $75 million in 2023. So there is an embedded loss in this particular loan that will be hard for investors to kind of recognize. The servicer still is putting out a balance of 125 million spread across two loan pieces, part of CMBX 8. If the borrower were to pay this off in 2023 for 75 million, there would be $50 million in losses spread across these two deals. And the way investors look at deals is they're always looking at what the credit enhancement is for every bond in the deal. So let's take this JP Morgan deal, 2014 C22. The AAA classes, when the deal was originated, when it was securitized, was 30% subordination. The AA piece, 17%.
So Matt, this means that it takes 30%, the whole pool of loans has to take 30% of loss before you take a loss, right? That's what credit subordination means.
So when you're looking at bonds, if a AAA piece has 30% subordination, you're saying, okay, this is where it was in the beginning, and it's a strong bond, and it should be compared to other bonds that also have 30% subordination. If a deal had 4 or 5 loan losses, the losses ate away some of that protection, that subordination could fall to, let's say, 20%. And theoretically, a person buying that bond with 20% subordination would want a higher rate of return than the investor who's getting 30% subordination, a bond that hasn't had any losses. So in this particular case, you look at the credit enhancement for, let's say, the original BBB- bond. Originally, it was 8%. Because some loans have paid off and defeased, credit enhancement is now 9.7%. However, when you take into consideration that there's this future loss sitting out there that may take place in 2023, unless you're laser focused on this bond and keep a string tied around your finger, you won't realize that the real subordination level for this particular bond is more like 2%. And if you're buying a 2% subordination piece for original BBB-, you probably want 400 basis points more in yield or more than one that has 9% subordination. So this is a very intricate story. It's something that for those that are tourists in this business, they're not in the CMBS side or are not clients, I'm happy to share this with you because it's a very interesting story, a little bit hard to explain. Hopefully I did justice to it, but some really deep stuff here.
Well, it's kind of weird. I'd have to look deeper into it, but why wouldn't they just write down the balance today unless there must be something in the mod doc that says you're allowed to pay us off at whatever it was, 72.5 million. But if you sell for more than that, then you have to pay us back more or something, right?
It's possible that that's what it is. Yeah. And there may come a day down the road where the servicer says, you know what, we're just going to write these things down now. And if we get more, that's great. But it is one of those things that for people that don't own this bond currently, if it's offered to you and you don't know this story, it will be easy to get picked off. And I hate to say this because I hate people taking advantage of other people. If you do have this bond, it may be time to sell this thing before 2023.
Yeah, that would be, as John Garcia taught me lately, the difference between a good sale and a good trade. That would be a good sale. not a good trade.
But ping us if you want to see the story, and we're happy to share it out to those that want to see what we're talking about.
So no digressions today because we have a lot to go through, but I just have to mention that this story, the Las Catalina Small, reminds me of Manis's favorite movie of all time, which culminates in the Catalina wine mixer. Just letting you know that I've never seen Manis laugh so hard as when he saw that movie. So if anyone wants to give us a shout out on their favorite movie, let us know.
Yes, it's that dream sequence at the end with the nymph and the lumberjack. I mean, the absurdity of the whole thing, like, yeah, it was just ridiculous. Like, I don't think I've ever laughed that hard.
It's the Catalina wine mixer.
And the other trading alert brings us to the Fashion Outlets of Las Vegas, which was known as the Prism Outlets Mall.
Wow. Yeah, I have a lot to say today. I hope we don't lose our loyal listeners. So the Prism was the Fashion Outlets, as Martha said. It backed a $62 million CMBS loan. That CMBS loan was in a CMBX 6 deal. As we know, CMBX 6 has been heavily shorted by MKP and by Carl Icahn. They have been waiting for days like this. This is kind of like Christmas and the Super Bowl and 4th of July all in one. This particular asset was auctioned by Tenant yesterday. The asset had been carrying a value of $28 million. Although Kroll and others had suggested the value was closer to 10 million. In addition to having 62 million in outstanding debt, it had $20 million in outstanding P&I advances, appraisal reduction advances, other advances. The sale price of this, and I wasn't going to give it away, except that I've seen it now in print from Bloomberg and others. I wasn't going to give it away to protect 10x's proprietary data. The sale price, $1.5 million. So you're looking at a loss after you pay back this $20 million in advances. We are looking at a loss that is going to be about 130% of the outstanding loan balance, which means that losses will eat up to the BBB minus class and part of the BBB minus class. And there will be a credit event where anybody who's long that particular credit will have to write a check to those who are short to cover that loss. So this is the kind of thing that people like Katie McGee and Dan McNamara have been waiting for and calling for a couple of years. And it just goes to show that this can happen, right? You can have losses that exceed the balance of the loan and just really punish a CMBS trust.
1% of the value of the appraised value from 2012.
Right, 125 million, if I remember correctly.
Yeah.
1.5 million, and interestingly, the reserve was met. Right, so assuming due diligence allows for this property to be liquidated as such that the deal goes through, look at 1.5 million via the auction, less whatever fees there are. There'll be some liquidation of reserves and other things that they will capture. So liquidation proceeds will likely be more than 1.5 million, but you're still looking at a loss of, it could be as high as 75 million. And this won't be the last one.
No, this is an outlet mall that has been beleaguered for a number of years, and it lost some key tenants like Nike. They tried to rebrand with a name. They tried to add entertainment value that included escape rooms, murals, axe throwing, and a number of other things. And it happened in December of 2019. And of course, we know what happened in 2020. So the entertainment draw didn't happen.
And for those that are wondering, we did see losses of 90%, 95% going back to 2005 and 2006 when malls got obsolete in some markets. It's not unusual. We'll talk about another one a little bit later. And we are seeing several examples of malls that are in loans that were securitized in 2012, 13, 14, for which the value has fallen 75% or more. So as I said, not the last one.
So let's move on to the Philly area, which has a mall owner looking to get some new zoning approval.
Yeah, that would be Preet. A lot of malls in the PA area. I think other parts of the Northeast as well. They came out with an article this week joining others, right, in this march to convert. We've seen examples of people converting to logistics operations. We saw the one in Cary, North Carolina, that had been bought by Epic Games. Preet came out and said that they are going to look to convert some of their mall space into apartments. That particular REIT filed for bankruptcy in November, and it's just one that has been of concern, right? Macerich, very heavily shorted. They're heavily watched. CBL is another. So all of these REITs that are, mall operators primarily may have to face this decision at some point in the near future.
So it's funny, I since moving up to my new neighborhood up here, a couple times we've gone out to pick up some takeout sushi, and there's a sushi place in the middle of town. And when I went to go pick the food up, it's kind of off to the side of what used to be a Kmart, right? Which is giant. And then right next to that used to be some sort of grocery store, but that's also vacant. So both are vacant. The liquor store and the sushi place are doing great. The rest of it is vacant. The lights in the parking lot don't even turn on at night. So someone must not be paying their bill. But anyway, there was a story this week came out that they're demolishing the whole place and turning it into 150 apartments. So, this is I think this will become a more and more common theme. The question is just, do you have sponsors and investors with enough capital and enough chutzpah to take on that development project?
You had another one, Martha, didn't you, in Massachusetts?
We did the Silver City Galleria, but before we move on to that, I did want to point out that the Moorestown Mall, which is the one you were talking about, actually has a vaccination mega site as one of its tenants now.
Yeah, when I went the other day, it was an empty Kmart. So, those big open spaces are with big parking lots are helpful for this. I don't know if you saw the news today, but, at least in New York and to some degree down here in South Carolina, Chick-fil-A is just a place where any time of day you go, there's about 35 cars online, and they back up into highways, and they will have 4 or 5 facilitators try to get cars off the main roads and organized in such a way so that they could deal with these people as quickly as possible. It's really quite a machine. So today, it was either the governor of South Carolina or the mayor of a major city called in Chick-fil-A to help them organize their car lines at their COVID vaccination places. They said, you've done such a good job at your local destinations of getting people in and out so fast, regardless of how many cars you have. We're going to put you to work in the vaccination space.
Yeah, if you've ever been to a Chick-fil-A drive-through that's crowded, it's like they have 5 General Pattons out there moving you along, getting you, hey, you over here, you over there. I love it.
But they're General Pattons without the edge.
They're very
right?
nice.
They're nice
right? They
people.
don't slap their soldiers with their gloves, right?
That's right.
So let's go to Taunton, Massachusetts for the Silver City Galleria.
Yeah, I think that one you told us was going to be converted to industrial space. That particular one, we talked a minute ago about older loans that had big losses. This once backed a $137 million loan, had JCPenney and Dick's Sporting Goods, had Steve & Barry's, which was kind of a upscale, not upscale, it was kind of like a hip hop retailer, type thing, kind of appeal to the young, millennial crowd. It suffered a $108 million loss in 2012. It was resolved. So the point being, it backed a big 2005 deal. The point being that these big retail losses have been with us for a while, and they will be, and they continue.
Yeah, their anchors are who's who of closed stores: JCPenney, Macy's, Best Buy, Sears.
There you
It just
go.
goes to show you like the residual value and the replacement cost analysis on these things is like near zero, right? Like once you're a defunct mall, there's really very little value in your property. Like just the property itself, forget about the tenants, forget about, generating cash flow. Like an office building in the center of town, if it loses 100% of its tenants, its value drops, but like there's still residual value and potential value in the future, which makes it not go all the way down to zero, right? But for some of these malls that are just defunct or, 10 years past their prime, and they just lose almost all value, which is hard to believe.
So let's turn to multifamily. We had talked about Long Island City last week, and it looks like we are going back to Long Island City.
Well, it's part of a theme that we started writing about in Trepp Wire maybe a month ago. We had noticed that there was several $billion of loans that had seen sharp declines in occupancy over the last 9 months. We put out a list that I think we circulated to our listeners back at the time. It was heavily tilted towards New York and San Francisco. There wasn't a lot in secondary and tertiary markets. One of the big properties at the time was the Geary high-end 80-something story building in Lower Manhattan. But over the last 30 days, we've just seen a lot more evidence of this in New York. In Midtown West, we've seen some of this in the financial district. We've seen some of it. And as you mentioned, Martha, in Long Island City, we have 3 or 4 properties now, and they're big. One was 800 plus units. One was 1,800 units that have seen occupancy go from, mid 90s down to high 60s, or in one case, high 50s. The one that's high 50s, that's the one that has 1,800 units. When it was securitized, it was replacing a construction loan. The new 10-year financing took out construction financing. It was a new $1 billion loan on a $1.6 billion value. The property occupancy was said to be 96% last year. And it's a little unclear to me if that was where they expected to be after full lease up, or that's where they were. But their latest occupancy number was 57%. So if New York City doesn't get its act together, this can continue to be a problem.
And while we're on this subject of New York, it seems that COVID has brought together strange bedfellows. We've got the property industry's main lobbying group partnering with the New York Legal Aid Society to change some of the rules involving tenant rights.
It's kind of like the GameStop stuff when you have AOC and Donald Trump Jr. on the same side of an argument. Things are upside down. I think a lot of times these landlords cannot get any sort of relief unless they have evicted tenants. And right now you can't evict tenants, right? So they're trying to come up with a way to get some relief to the landlords without at the same time. I don't know where it goes from here. At some point, somebody's going to have to pay something, right? If the tenant can't pay the landlord can't pay the bank.
Well, yes and no. To the extent it rolls up to Fannie and Freddie, the government could just make whole on this, and then it's the taxpayer, which, a lot of times with these things, the taxpayer doesn't really understand, and I'm not calling people stupid, but it just kind of happens under the radar in that, if you have student loan forgiveness, that comes out of everybody's pocket. That money has to be paid back somehow via taxes or reduction of services or something else. The same thing if you bailed out landlords via Fannie and Freddie. Where you'd see the bigger problems without a bailout, of course, is in the private label CMBS market, right? Or the REIT market, right? Where there's equity and so forth.
We've been talking about it for a while. I think that the consensus among everyone that I speak to, both internally at Trepp, sales guys who are talking to, investors, servicers, and brokers all the time, and also on the bank side, I think the consensus is that 2021 will be the year of the reckoning, right? I mean, you have that married with COVID vaccine, recovery, stimulus, people getting back to work, people having lots of money to spend. So hopefully the reckoning meets with an equal amount of exuberance and spending, but there's definitely going to be tons of opportunity for the distressed players this year.
And in office news, we had a number of announcements that corporate offices were going to be closing.
It's been the speculation for 6 months, right? That companies are going to opt out of leases, take less space, let people work from home. And over the last week or so, we've seen several stories to this effect. Johnson Controls, they have 420,000 square feet in Milwaukee, 1,300 employees. Over the next 2 years, they want to convert to permanent work from home for those employees or move them out to I think it's Glendale, Wisconsin, which is a suburb of Milwaukee. So they plan on giving up that space. Lincoln Financial indicated that they're going to let the same thing happen to hundreds of employees in Concord, New Hampshire. United Airlines this week announced that they were going to give back 150,000 square feet of space at the Willis Tower in Chicago, exercising a lease termination. They'll keep a lot more. They'll keep another, I think, 600,000 square feet there or so. But in Chicago, that's becoming a real problem. We've now seen Bank of America build their own headquarters. That's several 100,000 square feet that they'll relinquish in one part of the city. We've seen a number of startups, Toast, which is a startup, 50,000 square feet, Uber, PayPal, I believe, was another, the Tribune companies, all giving up big swaths of space. And this could really weigh on that market for for a considerable period of time. There's just a lot out there. You also face the situation in Chicago where people are talking about higher taxes. Companies may relocate away. And if there was, I think New York is the biggest problem for multifamily. If there's a biggest problem for offices, it's going to be either Houston or Chicago. And right now I'm thinking Chicago. Lastly, in the closing, WeWork said that they were going to close 4 locations in Washington, D.C. So it's really spread everywhere.
Martha pointed out an article before the podcast from Visual Lease. I guess that's a software data company in the leasing space. They ran a survey of their clients. Now, I don't know exactly how many or how big this survey is, but it says that the respondents spanned across retail, manufacturing, technology, healthcare, among others. Key survey findings include roughly 3 in 5, it's about 60%, 3 in 5 companies reported a loss in revenue since the start of COVID-19, not surprising. 80% of the respondents expect the financial impact to be short-term. 38% of respondents reported that COVID-19 related terminations have impacted the number of lease agreements under management. So in other words, 38% have had some sort of decrease in how much space they lease. Right. And then 39%, here's the big one, right? 39% had no plans to downsize office space. 18% already had done it. 37% were considering or planning for it. So that's, 50% of the market has either downsized or is planning to downsize. It's not, it's kind of not that surprising. I think that
big number though.
It's a big number. I think you're just going to see this for the next 5 years. It's like as leases roll, every single company is going to reassess what they're doing, right? And I think the only kind of, again, that kind of like reckoning versus recovery story, the only positive spin I could think of is in places like New York and Chicago and San Francisco and others, there's always going to be new up and coming entrepreneurs and businesses opening up and potentially trying to take up space, but maybe not. Maybe the new entrepreneurs are going to be remote.
Yeah, to turn to a positive note, we did see, I think Amazon this week announced another 600,000 square feet to be taken in the Seaport area of Boston.
It could be that every company works from home except for Amazon and Facebook, right? And who else? That's it, really. Those are the ones that are taking up the office space right now.
Right, Google.
The actual tech companies that are creating the work from home abilities, they're the ones that are going to be in the office.
Irony. That's irony. So let's look at the deals of the week.
Yeah, so I'll do this deal of the week this week because I was so excited. Ira Krumholtz from Colliers actually sent this to us. He shared an office sales sale in Ohio, and I'll just read a couple of the things here. So the office had been in receivership for almost 3 years. Gary Cooper, what a great name, and Anthony DeMarco of the Cooper multifamily team of Colliers International represented the seller of Vista Apartments. I said office sale, that got me a little bit confused. It's the Colliers office which made the sale in Euclid, Ohio. And I love this quote: "This opportunity wasn't for the faint-hearted, inexperienced, or undercapitalized investor. However, after a very competitive marketing and offer process, we selected a buyer with the vision, courage, and equity to buy an irreplaceable asset at a fraction of its replacement cost and its potential market value." So really great. Love getting that input from listeners and love being able to highlight people's deals. That's the whole point of Deal of the Week. So thank you, Ira, for giving us that shout out.
Shout outs of the week, and listeners will have to be patient. We had scores of shout outs this week for a number of different calls to action. And the first round were some general responses. We had Tammy Goldfisher from the Henley Group. She's actually been on our podcast in the past and tells us that she listens to back-to-back podcasts while driving to Sugarbush with her daughter, 15-year-old daughter, listening. So thank you, Tammy. And for your daughter, I'm sorry that you're subjected to hours of our podcast, but it's good education, shaping young minds.
That's right.
Punishments.
Keep listening.
And Alex P., who has a handle, Simple Simon, did a YouTube video, which is an absolute first, and did a video shout out where he went into detail of our multiplier educational segment with Lonnie Hendry. So we actually got to watch his video talking about our podcast. So it was a very interesting.
Like Inception.
Yeah, a little bit.
Like a mirror in a mirror in a mirror. Bill W., who sent us something asking, first of all, saying, thanks for the good podcast. Thank you for saying that. And mentioning that we should talk about debt yield as an educational segment, which we will in the coming weeks. He also gave us a great offer to play golf at a very exclusive golf course, which it's not anywhere near where I live, but I might be taking a road trip sometime soon to take advantage of that offer.
You're not going to be alone, Joe. You're going to have some hangers on.
Martha, you can come. I don't think Manus wants to come. He doesn't want to sully the history of this golf course with his game.
It's kind of like I played a little piano when I was a kid. If somebody said that's a piano that Beethoven played on, I would not sit at the piano and play, right? I would not be worthy. If somebody said, let's go play baseball, we can sneak into Fenway Park and play a little sandlot. No, you're disgracing the place. I was never a great baseball player. Right?
Or would you play basketball at Rucker Park?
I would play basketball at Rucker Park. Back in the day, I had a little bit of game. Towards the end, I was, for those that follow basketball, there's that term triple-double, which, it was for guys that would have double digits in points, assists, and rebounds. Towards the end, when I wasn't making V cuts anymore, I was making kind of like C cuts. I was always, accused of getting the triple single, one turnover, one missed free throw, and one failure to hit the rim.
I did like this Twitter handle, Fourth and Jort. They're like seemingly one of those financial Twitter meme accounts. Gave us a nice chicken wing meme from Tommy Boy, which is kind of full circle because we usually have Tommy Boy references on the podcast as well. We had, I think I counted it, like 25 or 30 people reach out to us about that Eisner Ampner webcast that we did, Barstool Fund donators, looking for multifamily stories, looking for t-shirts. I'll do a quick read of some of them here. Elon, Cathal, Todd, Tyler, Chris, Olivia, Janet, Adrian, Randy, John S., Rico, Sanjay P., Andrew L., Jason C. I have to make a stop at Brian F., who told us that he listens to the podcast while he's hitting golf balls at the driving range. Brian, you're my boy.
That's where I should be, so that I get ready for that golf outing. So that when you go there, I'm only losing 2 balls, not 8 balls.
Come on.
Listen, on this Barstool list, we've got a good, healthy number of folks that have donated on Manus's challenge. So Manus, open up that checkbook. You've got some matching funds to consider.
There will be a check sent in this week, or I should say it'll be more like a web send in on my credit card. But yes, we'll live up to that promise, which was $50 for everybody who gave us a shout out on Twitter or via email and so forth. And I will gladly do that. It's one of those things I'm happy to support. And I'm going to meander a little bit. I'll try to keep this one short. When it comes to going to restaurants, I really, even throughout the pandemic, I'm kind of a mask moderate, right? I'm not afraid of going inside and eating. I have my mask with me. I don't want to be stupid. I don't want to take any chances. But if it's 30% full, I will go in for a good meal, once a month. By moderate, I'm not wearing 4 masks. I wear 1 mask. I don't wear it when I'm driving by myself.
I don't know if this is a thing, Manus.
Well, anyway,
moderate.
So my point being, I like going to restaurants and I like sitting there and having a nice nice dinner and a glass of wine. But I do find this, that when you sit down and there's that little inkling of doubt where you say to yourself, but there's that 1% little bit of doubt that maybe I will get COVID from this. And I don't really panic. I don't really think about that much. But all of a sudden, I'm completely thinking, if I'm going down, I'm going down big, right? I'm going to take the porterhouse with the triple shot of béarnaise sauce, right? I'm going to take 2 orders of the chocolate lava cake. I'm going to get the au gratin potatoes and the scallop potatoes, right? Because if I'm going down, I'm going down big.
Why don't you
right?
just do take home and you don't got to go down at all?
I'm just thinking, like, if this is I'm like a condemned man.
You're like the
right?
last meal. Yeah.
Right. If I'm a condemned man, like if I'm going down, I'm going down with the Widowmaker, right? The deep fried, baked brie, clog the arteries.
That's kind of how, I think that's kind of how you and I order at restaurants anyway.
I don't think it's COVID that's going to be the problem. Yeah, it's not going to be COVID that's the problem.
Just to finish off a couple of the shout outs. So we have to shout out the guys and gals who donated to Barstool. So Josh H., Brian F., David, Brandon, Kevin, Omar, Baker, and then Mark, Lara, and Lenny, who asked for the multifamily story. So we won't read out everybody's name every week, especially as this list grows longer, but I do love to, I'm sure a lot of them are listening right now. So thank you. Thank you again.
And rounding out this week's podcast, Hall of Famer Hank Aaron died suddenly last Friday, and he's ranked as number 2 on the all-time home run list. Or is he?
It's funny about Hank Aaron because we've seen so many guys pass away over the last years that were iconic, right? Tom Seaver, Bob Gibson, Lou Brock. And whenever somebody like that, Kobe Bryant, whenever somebody over the past year like that passed away, my memory always shot to something that they did athletically, which was, the 69 Mets or Bob Gibson's 17 strikeouts in the World Series game, Kobe Bryant's 81 points. All these things are the first thing. Lou Brock breaking the stolen base record. But it was interesting with Hank Aaron, and the Wall Street Journal wrote an editorial about this, and I think the New York Post did too. So I hope people don't think I'm stealing, from their original thoughts. It was the very first thing that came to my mind was not his accomplishment on the field. It was the dignity with which he saw his record broken, right? If ever a guy was going to be annoyed that somebody broke his record, he could have been the guy. Instead, he flies out to San Francisco. He gives Barry Bonds the attaboys, a man of incredible dignity. And in this time of incredible polarization, it just stands out even more. There's such a shortage of statesmanship and leadership that I just thought for those 5 minutes when I was thinking back on him and how he carried himself, his last act pretty much in the last month of his life was trying to convince people to take the vaccination, people that might be reluctant to do it. So talk about a guy that, you just really look at and can be proud of as an American. That's the first thing that came to mind, not the home runs and the records. That was it.
And what more is there to say after that? With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we discuss what's happened during the week and how it may be impacting you. If you have a question, a comment, if you want to donate to the Barstool Fund, email us at podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.